This week opened with Iran threatening to close the Strait of Hormuz. It ran straight into the hottest inflation prints in 3 years, and it ended with the largest IPO in history and the federal government ordering one of the world's most advanced AI labs to switch off two of its models at 5:21 on a Friday evening. The S&P 500 still closed green. That one fact tells you most of what you need to know about the bid under US stocks right now. I'm David Berkowitz, and this is the weekly market and value aligned portfolio review for June 13th. Over the next few minutes, I'll show you what moved, why it moved, and what it means for the companies we own. Here is the week in four numbers. The S&P 500 finished up 0.6%, closing at $741.75. Small caps, the Russell 2000 jumped 4%. May consumer prices came in at 4.2% year over year, the hottest since April 2023. And SpaceX popped 19.3% on its first day of trading. Four numbers, four completely different stories. Start with the rotation, because it is the cleanest signal on the board. Small caps led by a wide margin, up 4%. The NASDAQ added 2.3%. Equal weight gained 1.8% and beat cap weight, which came in at 0.6. When equal weight beats cap weight, money is leaving the crowded mega cap names and spreading into the other 493 companies. Ed Yardeni's team flagged this directly. The Magnificent Seven group is down 2.6% this year. The other 493 are up 9.4%. That is not a market falling apart. That is a market broadening out. The sector tape tells two stories. First, materials and staples led. That is a classic late cycle inflation hedge combination, and it lines up with the hot producer price report we will get to in a minute. Second, look at technology. It finished up 2.5% on the surface. Underneath, the split was violent. Semiconductors surged 8.8%. Software dropped 5.4%. Same sector code, opposite outcomes. Hold that thought, because it is the most important idea of the whole week. Here is where that hardware strength shows up. The five biggest gainers in the entire S&P 500 were all chip names. KLA up 32%, SanDisk up 27%, Intel up 26% on a Bank of America double upgrade, Applied Materials up 25%, Lam Research up 21%. Every one of these makes the equipment or the memory that AI runs on, and the news backed it up. TSMC reported record May revenue. Samsung opened next-generation memory talks with NVIDIA. Micron pushed ahead on its $100 billion New York megafab. All of that flows straight into these order books. Now flip it. Four of the five biggest losers were software. Adobe down 19%, its lowest level since January 2019. PTC down 17%, Oracle down 14%, its worst week since 2002, after reporting capital spending up 162% and negative free cash flow. Autodesk down 14%. The one hardware name on this list, Supermicro, fell 27% on a $7 billion stock sale that diluted shareholders. But the other four are all per-seat software, repriced on the same fear that AI agents can now do the work those subscriptions used to charge for. This is the divide in one picture. Same index, opposite outcomes. On the left, AI hardware, the chips, the memory, the equipment, the fabs. That is being bid up because the demand is real and visible. On the right, per-seat software, the applications that charge you per user per month. That is being repriced lower because investors are absorbing a new idea. A frontier model can do more of the work that software used to sell. Where AI sells silicon, the bid is real. Where AI threatens recurring software revenue, the multiple keeps shrinking. I will come back to why this matters for what we own. The inflation prints were the week's main event, and they were not good. Producer prices ran 6.5% year over year, the fastest in more than 3 years. Consumer prices hit 4.2%, the highest since April 2023. Energy did most of the work, up almost 24% year over year. The more reassuring part is core inflation. Stripping out food and energy rose just 2.9%. The tariff and energy pressure has not bled into the core yet. Meanwhile, the economy is running hot. The Atlanta Fed's tracker moved second quarter growth up to 3.3%. Bank lending is up 7.7%. The Fed is now expected to hold, with a possible first cut in December. Hot economy, sticky inflation, patient Fed. That keeps real rates higher for longer, and that is exactly the backdrop that punishes long-duration software the most. I want to step out of the weekly numbers for a minute, because the biggest thing happening in 2026 is not any single data release. It is a question. What is AI really? And what does it mean for the businesses we own? The clearest frame I have found comes from George Gilder. His argument is that the economy is not a machine grinding toward equilibrium. It is an information system. Wealth is knowledge. Growth is learning. A caveman had the same physical atoms we have today. What separates a cave from a microchip is not stuff. It is accumulated knowledge. Here is the part that matters for AI. Gilder argues a machine cannot replace a human mind because every computer needs what Alan Turing called an oracle, a source of judgment outside the machine that supplies the starting truths. That oracle is a person. As Gilder puts it, consciousness does not emerge from thought. It is the source of it. So AI is a prosthetic. It extends a human mind the way a backhoe extends a human arm. It lets one expert do the work of 10. It does not erase the expert. Quick break for the serious investors watching. If this way of thinking is why you follow along, the companion video I point you to at the end goes deeper on how we turn it into actual portfolio decisions. Stay with me. Back to the tape. 3 events drove the headlines. 1. Iran threatened the Strait of Hormuz early in the week. Oil spiked and chips sold off hard on Tuesday. Then Thursday, President Trump postponed planned strikes and said a deal was close. The S&P jumped 1.8% that day, its best session since April. 2. SpaceX went public on Friday, priced at $135, closed at $161, up 19%, valuing the company above $2 trillion, the largest IPO ever. 3, and this is the big one, Friday evening at 5:21, the Commerce Department ordered Anthropic to disable its 2 most capable AI models, Claude Fable 5 and Mythos 5, for every foreign user worldwide. Because the company cannot filter by nationality in real time, it shut both models off for everyone, globally. Think about what that action actually means. The US government just treated frontier AI model weights the same way it treats weapons. An export-controlled, license-required, dual-use asset. Foreign access now needs a license. That adds compliance friction to every commercial deployment that touches an overseas user. And any product built on top of a single frontier model now carries a real resilience risk because the government showed it can switch that model off on a Friday night. The software sell-off did not start with this order, but it sure did not help. Now to the portfolio, name by name, winners and losers, the way I always do it. Top 5 this week. ASML up 13.5% and up 74% on the year. It is the only company on Earth that makes the high-end lithographical machines every advanced chip fab needs. The whole AI build-out runs through its order book, and this week it became the first European company worth over $700 billion. Inter Parfums up 11.5%. Prestige fragrance riding a high-end consumer that keeps spending. AMD up 9.7% and up 139% this year. after claiming a big performance edge on its next chips. LVMH up 8%, a bounce off oversold levels. It is still down on the year, so I stay patient there. And Home Depot up 5.7, moving with the home builders as long rates stayed contained. The thing to notice, the names that supply the AI prosthetic led the whole portfolio. The bottom five tell the other half of the story. Salesforce down 10.7%, now down 37 on the year. ServiceNow down 9. Both sell software by the seat, and both sit right in the path of AI agents. Microsoft down 6 on capital spending worries and the Anthropic shock. Apple down 5, mostly profit taking, and still the only name here that is green on the year. Accenture down 4.5, with the market worried that AI commoditizes routine IT work. Here's the Gilder frame again, live. The parts of these businesses that extend a real expert should keep compounding. The parts that just sit as the routine layer between a customer and an answer are the ones under pressure. I was working with a client recently who wanted to dump every software name in a panic. What we worked through was the difference between the two, which holdings still extend a human mind and which are about to get extended past. That is the actual work, and it is why we go name by name instead of reacting to a red screen. Looking to next week. The bull case. The Iran deal holds. The market reads this inflation as energy-driven and temporary. Retail sales come in firm. The rally keeps broadening, and the S&P retests its record near 7,600. The bear case. The Iran deal falls apart. Oil rebounds. The Fed sounds more hawkish than expected after these prints, and the software sell-off drags the rest of tech down with it. Watch four things. Semiconductors, the leadership group. Oracle, the tell for whether software is finding a floor. Crude oil, the cleanest input to inflation. And the 10-year Treasury yield, above 4.5%, puts fresh pressure on software valuations. The Fed also meets Tuesday and Wednesday. No rate move expected, but every word of the press conference gets parsed. Three things to take away. First, the rotation is real. Small caps, equal weight, and the non-Mag 7 part of the market are leading, and those names are up over 9% this year. That is healthy. Second, the AI split is the dominant theme. Own the businesses that supply the prosthetic, or that use it to extend a real expert. Be more careful with businesses whose whole moat was being the routine cognitive layer. Third, frontier AI is now export controlled. Resilience and a multi-model strategy matter more than they did a week ago. Own great businesses, stay grounded in the long-term compounding thesis, and wait toward the ones still extending a human mind. If this was useful, and you want to see how that information theory frame turns into real portfolio decisions, watch the companion breakdown right here, where I walk through the three buckets we use to decide what to own.